when you're up 50 to 75 pips, you got to move the stop in behind the next strike zone stop hunt into the next level. We'll talk about it, okay? My favorite is a jumping stop where you manually jump the stop. I do not like a trailing stop. And the answer's simple. Why? Who provides a trailing stop on the platform for you? The dealer. That guy ain't your friend. I've met more good traders that have been trailed out by a trailing stop and they were going the right way because they didn't understand how to jump into the consolidation zones. Now, with that said, if you ain't going to sit up all night, I'd rather you trail the stop than do nothing. Because it's a crime to be up 45 pips, miss your take profit by a hair, and come back and wake up to a stop out. That's unacceptable. That's a 40 to 60 pip swing against you, in your favor and back against you, and you ate the stop. That's a crime. I don't care what country you live in, that's a crime. It's high treason to the method. Okay? The goal is to preserve your capital while you're learning and to grow it. That's the business. If you can treat a demo like real money, I applaud you for that. I'd rather use a demo while you're learning. Because I want you to preserve your capital. But if you cannot and you have a couple grand, why not open a micro with $500 and practice with real money and leave your other equity set aside? That's a better strategy. And then when you become successful, you have all your equity left. Okay? Important. And if you do like Casey, where you take a small account and triple it, you'll have more equity to put on top of your equity. It's just a better way to go about it. Yes, Nick. That's true. Okay. Trading systems continue. You got to have a profit target. It's got to be fixed, projected, or based on stops for swing traders, or based on the reverse signal when you become proficient in understanding. If the M is the entry, then of course the W or A top is the exit. Right? I'm sorry, if the M is the entry, the W is the exit. If the W is the entrance, the M is the exit. The opposite signal at the appropriate time is the exit. If you insist on taking the entire run of 255 pips, that's okay. If you grab the low, even if it comes back into mid-range consolidation, you'll close the day around 50 pips. Think, they spike the low, they raise price all the way up. If you don't move your stop, and you were right today, which you should be, right? They're going to come back mid-level. If you never moved your stop, you're still good. You're going to end up with plus 50 or so in here, depending on the ADR of the pair. But why when this was the exit? Okay? It'll come. It takes time. It's a journey. It's a process. But the rules that are used by regular traders, because you do not have unlimited equity, apply to you, but just using them for our methods to trade. Okay? Okay, you got to have money management. When you're learning, I want you to use about 1% risk. One mini lot, one micro lot, depending on your account size. We'll talk about that. There's a sheet provided. You got to have a way to manage your money. And if you don't know how to figure out your stop loss, you take distance to stop times lot size, right? Lot size times pips, or distance to stop equals your risk. Take that as a percentage of your account. Okay, if you have a $5,000 account, a 10% risk would be $500. A 1% risk would be $50. Okay? When you look at some of Rick's statements and trades, I don't know if he's in here or not, he does ramp up his risk. But I can tell you that he ramps up his risk on small accounts after he's already made multi-six figures trading this way. So if he burns $5,000, he don't care because he'll come right back at it. If it's your last $5,000, I want you to treat it like it's your last $5,000 and trade it with respect and don't burn your equity down. When you make multi-six figures, you want to throw $5,000 and trade 50 standards and go crazy. That's okay. But let's make some money first before you start doing some of the stuff that Rick does. All right? Rick, I'm not picking on you. I love you, man. I just want to make sure that they don't look at your statements and get jacked up. All right, it's doable. If I can teach one man to do it, I can teach any man to do it. Yes, 1% risk initially. First couple of trades, get comfortable, make sure you're seeing everything right. And if you could do it on demo, even better. But if you don't treat demo right, don't use demo, use micro. Okay? And if you don't know where to deal from, that's what Kim and Compass are here for. Contact them immediately and get you set up where you need to be. Let them do that for you. That's one of their tasks here with us today. To get you dealing from the right place, a place that has micros, a place where they're not going to trigger your stops every 5 minutes. We want you to be in the right dealers. Okay? All right. Understand, very important, that the market maker pattern that I've drawn for you and laid out for you outweighs any man-made indicator. All right, let me say that one more time. The pattern I've so far illustrated for you outweighs RSI, TDI, moving averages. It outweighs everything. And I always say this, the pattern is the top 3 things you need to be concerned about. You react to the market maker's actions, you will have profit. You will be successful. In order for us to understand how to read charts and identify the market maker's intentions, I took some widely used indicators and applied them to a chart to help us understand the timings, entries, and exits. I took the work time ribbon that somebody made in Russia and I programmed it, or had it programmed. I don't program nothing, just kidding. Had it programmed to match the Tokyo channel and the US session reversal. I took some shadow boxes, thank you, Ray, and put in the key times when market makers issue the Brinks trade. That's what the shadow boxes represent. They represent the times when the Brinks trade will present the stop hunt zones, and I will cover all that stuff, don't worry. Divergence and TDI and RSI, the bands. I'm going to explain how to use all that in conjunction with our methods. But understand the students that are having more success, as they move forward in their success, they shed the crap off the chart. Okay, I wanted to announce to everybody, Ray mentioned this to me and I forgot, and he just reminded me, that he is currently coding a new version of the work time ribbons that will automatically ping the broker server, grab his GMT time or the broker server time, and match it up to for our needs. It'll be ready soon, I don't know when. If you want to bother someone, bother Ray. I'm going to put his phone number up here in a minute. I'm kidding, man. We're not going to do that. I know, it'll be ready. So any broker that you drop it on, the boxes will shift necessary for our methods, okay? It is going to be good. Since most of you know how to use all these indicators and have fallen victim to popular technicals, using them allows us or you a faster transition. You know what divergence is. If I could show you how to spot divergence during the stop hunt in context of what we're doing, you're going to pick it up faster. If I could show you how to pick a hammer, which is a common candlestick pattern, at 3:45 in the morning, second leg of the W, you're going to pick it up faster. So we've incorporated some of the standard technicals onto the charts to help you see. The goal and the dream for all of us is to shed that stuff and trade maybe the boxes, the ribbons, time ribbons, and a couple of maybe moving averages for where they're going to form the zones. Stop hunt to the mayonnaise, reversal. Okay? That's what I'm talking about. Okay, for the purpose of this class, the EMA 5, 13, 50, 200, 800 will be used. How do you remember? Mustard, ketchup, water, mayonnaise, blueberry pie, whatever you want to call it. All right, here, look. Mustard, ketchup, water, mayonnaise, blue, whatever. Okay? We're going to cover some basic candlestick patterns. Hammers, railroad tracks, spikes to the high, outside bars. It's not stuff that you haven't already seen. I didn't invent them. Candlesticks have been around since the 1600s. I think when they used to trade rice, they used to use them back in the day, commodities. But here's the thing about them. A hammer in the middle of a run is worthless, in my opinion. Steve Nissan will probably yell at me. But here's the deal. A hammer issued at 345 or at 945, a hammer issued as second leg of the M or W formation, understanding the context of the market where you are, will help you to understand our setups faster because you've studied this stuff. Okay? Railroad tracks, double bars, or if you're using a bar chart, railroad tracks look like railroad ties. Is simply market makers run up there, grab the orders, and come right back down. Or vice versa, down and come right back up. Understanding that, right out of the blue box, as three vectors on one side and then the railroad track pulls away, that's going to help you understand the setups. Okay? We're going to use color-coded sessions. The work time ribbon codes the sessions for us to understand where we are in the cycle. I'm going to cover it. You got some crossovers, arrows with alerts. We use 51350, right? The 513 crossover is the signal line. Here's the thing about the averages. If you wait for the average to cross, you're kind of late to the party, and that's not what I want for you. The 513 cross fires most of the time when they shift the zone away from the level traders. When they shift the zone down from higher level longs, the 513 will cross. When they shift the zone off of lower level short holders, the 513 will cross, the arrow will fire. A lot of times, that shifting of the zone will put you into monster profit immediately. When the arrow fires, it is not an entry signal. It is a confirmed confirmation that you are still in the right direction. Okay? Moving averages in the wrong context of the market are worthless. And I mean absolutely worthless. It's like trading spaghetti, right? Sideways, chopping. The moving averages in the Asian session, they're worthless. The moving average crossover after the stop hunt and the W or M forms, and they shift the zone and the arrow fires, confirmation I got it today. That's what we're going to cover, how to use them in the right context of the market maker patterns. And because we're using stuff that's common technicals, the transition will be quicker. Yesterday's high-low. High of the day, low of the day. HOD, LOD. It paints on the chart as a light blue marker. And I cannot say enough important things about that light blue tracer. If yours is not working, if it's not painting right, if something's wrong, if they're smashed together, those things happen, I'll send you a fresh set of indicators. We'll zip the file up and get it to you. Kanan can do that for you. Pivot points. Pivot points are kind of crazy. They're intraday support and resistance. Here's what happens. A lot of the times, you will get your 3 swipes at the low right to an M1 or M2 pivot. It'll pull back and make the second leg at the same pivot point. That just helps you to trade. Do you need them? No. The pattern, the pattern, the pattern. Some people like them, some people don't. I'm not offended. I didn't invent them, but there's some targets on the chart that help space out where the stop hunts may occur. You have the boxes. If you don't like the pivots, get them off of there. TDI, can't say enough good things about TDI. Dean wrote it, but in the context, the way we use it is a little different than how he uses it. And I'm going to show you. We have trades called shark fins. I think Dean calls them hooks. We have a trade called shark fin long, hold the mayo. It's not a sandwich. Shark fin short, hold the mayo. I'll talk about it. When these signals appear in conjunction with the market maker behaviors, solid gold. Back up the truck. Brinks. The third most important element of the system is the market maker level count. A lot of people struggle with this. And listen, I'm no exception, man. I'm not some Harvard scholar. Sorry, Masood, if you're in here. I'm not making fun of you. It took me a while to figure out what the hell this guy was talking about with the levels. I suspect it will take you some time also. But understand this. You can and will be profitable identifying the market maker patterns and the timings, the levels will come. Okay? They will come to you, I promise. ADR, average daily range. I seen ATR, average true range. We go back 15 periods. Intraday is 15 days. Gotcha, Maseo. We take an average of those 15 days. You know how an average works. The last one drops off, the next one is calculated. It takes an average of its behavior and plots a couple of lines on the charts. A confluence of events. Remember what I said, a confluence of events? Multiple things happening. Think about all these things that are up here. If tomorrow market makers come out of a 50 pip box, right? And they spike the low, they issue a hammer at M1 pivot, you get a shark fin and TDI, it happens to be level 3, just outside the blue box, right to yesterday's blue tracer at the low. This would be a confluence of things coming together. Understand? That's what I'm talking about. And these are the things over the next day and a half we're going to strip down and build back together so you can understand how to find these signals, the proper signals. All right? Just because market makers make a small consolidation zone, do not mistake that for an M forming, Tony T. That is not an M or a W forming. You have to know where you are in the cycle and the proper timings and context. Yes, Peter, exactly. Multiple things came together on Euro CHF last night